Good morning, everybody. It's July the 11th, and it's a Friday morning. The weather has just been amazing this year. Can't believe how hot it's been. And I think the markets as well have been as hot as the weather this year. Hot in terms of a number of things, and we're going to share some of those with insights this morning, Trenthams portfolio monitoring service and investment updates. So, first of all, we're going to talk about really what's going on in the world, world talk and news, key stories. There are so many, and there are so many that come out every day. We can't cover them all. But the key ones that we have looked at is the global unrest and the push for peace. The first half of this year, 25, has seen continued unrest in regions like Gaza, Yemen, and Central Africa. And there's been, a lot of conflict. It's intensified. Yemen has faced the Red Sea tensions, impacting trade. It's very aggressive and just not a nice place for people to be. Our friend, I have an orange Sharpie. So our friend, the Orange Man, Donald Trump, has played a growing diplomatic role, and he's proposed a 60-day Gaza ceasefire in those areas. So, and that's in aid of stepping towards easing global tensions. Earlier this year, we have Donald Trump's announcement of sweeping new tariffs across the globe. It just swept turmoil and financial markets awry. On the 2nd of April, Liberation Day, that was really when things started to turn, and we saw a very severe drop at the end of March, beginning of April, but it only lasted 4 days. It's probably one of the shortest drops and recoveries that we've seen. The one before we had was at COVID in 2020. That was a 3 to 4 week drop, again very severe, good recovery for the rest of the year. The one before that was global financial crisis, a few years. Before that was 2000 technology, that was 3 years. So things are seem to be getting shorter. Maybe it's the advancement of news, the faster speed at which news plays out around the world. And today, we have the complete opposite, the highest that the markets have ever been since we all know. And who would have thought we're here? I remember at the end of March, beginning of April, saying to people, it will turn back. There was panic, there was turmoil. There were people, oh gosh, what's happening? What's going on with my money? No, I'm not going to make investments. I'm going to wait until markets recover. And this behavior goes on, and I've just seen it for decades, literally. The market, will always come back. As long as we're all alive and breathing and in business, it will recover. Some businesses might go out of business, but new ones will come in and take that position and that place either on the FTSE or the S&P or whatever index that they're in. Our portfolios are fully spread across many different funds, many different stocks, so there's a lot of comfort in that. But what growth have we seen since the end of March, beginning of April? Just significant, really significant. I'll take you through some figures in a moment. Then what have we had? News about cash ISAs, about the only investment left that is tax-free and is such a gem in the financial armory that you can have as part of your plans. She considered reducing the cash ISA allowance from 20,000 to 4,000, and today, 11th of July, that has been shelved or deferred or pausing or delaying. If it's a permanent delay, I think we'll all be delighted. So coming on to the facts, and before we kind of look at facts, we're all driven by this behaviour, or, headlines and what might happen, and the mind plays out. But if we look at some facts and we think about longer term and we think about the horizon of our life, which is, well, it's quite a way down the road, then we just really want to hang on to these facts and the long-term view. So, cash yield. What could you expect to receive on cash in December 24? Well, that was 3.6%. The yield you can get on cash now, well, not now, but in March 25 was 3.6%, so exactly the same. And the cash yield hasn't changed over 6 months. So, a very secure, very stable place to be. If Rachel Reeves is trying to push people out of cash to go into markets where they don't know what they're doing, they don't know what to buy, it's volatile, all these scary headlines, why would anyone want to go in there? If you are very comfortable in cash, then by forcing somebody to go into the market, it really just is not a good place to go. So I'm glad she's deferred that. Current Bank of England base rate 4.25. You could put your money into cash, and the best 1-year fixed rate we've found is 4.4. That's with a company called Raisin. Fixed interest yields. So if we look at fixed interest, we go up a level of risk to fixed interest, which is government debt, corporate bit higher debt. The yield on that in December was 4.95. It's still 4.95. So that hasn't changed over a 6-month period. Majority of our clients, they fall into 2 categories. One is building wealth, and the other one is in retirement, preserving wealth and hoping they'll have more money than life. On a risk scale, we have 1 to 10. Our portfolios start at risk 3, and most of our clients are between 3 and 4. We've just been pulling together some information for our professional indemnity insurance. And one of the questions is, what are your top 3 funds in your portfolios? And they're at risk level 4. So that's where our clients' mindsets are. We follow the Willis Towers Watson asset allocation, which we have done for many years, and then just look at what they're recommending, particularly on the low-level portfolios, because if you can get better in cash and the returns aren't so great, then you'd be better off just holding it directly in a cash bank account. So we've looked at risk level 3, and the allocation is just over 1/3 in cash. I feel that's too high, particularly when you've got a platform charge, advisor fee, fund manager charge, and if you've got a pension pot that's invested for the long term, then I think we just need to rethink the allocation. So for this period, we're going to take 6% out of that, bring it down to 30, and put that 6% into fixed interest. We don't want to disturb the risk too much, because the thing is, you can change your portfolio too much and then you end up with a risk level 4. Well, if you think you're in a 3, but underneath the bonnet is a risk 4, that's not going to work very well. Particularly when we look at our standard deviations and our expected returns, your portfolio is going to behave in a different way to what you expect, and then there's going to be tension and not a good experience. So we're careful as to how much moving we do. We've put in our newsletter the allocations for all the risk levels 3 to 10, and cash disappears at risk 6. 6 onwards there's no cash, and fixed interest, which is the next level of risk, that disappears on risk 10. So there is a tiny bit in risk 9. So what have we seen in the portfolios over the last 3, 6 and 12 months? Well, for risk 3, in 1 month alone, we've seen 1.8%. In a risk 5, we've seen 2.38, and a risk 10, we've seen 3.27. So if you annualise these figures, it really does demonstrate what growth there is in the marketplace. If we look at the 1-year performance, it goes back for 12 months, so it includes the big drop and a recovery. So the 1-year figures are 5%, 5.4% and 6.3%. So what do people think at the moment? Well, when you see these nice graphs with high rising returns, people then think, oh, I'll put more money in and I'll take more risk. The trouble is, if you take more risk, you're buying at the wrong time. We had somebody who was going up the risk scale when the markets went down. They didn't want to go in. When the market went down, we put logic to it. We said you'd be selling at 0 and buying low. They changed their mind and they changed the risk. So they've gone up the risk scale at a low point in the market. So that was really great results for them. And I think that's testament to the personal service that we provide for clients, to not just take an order from you and not just say yes, because you can do that any way you like. You don't need a professional person to sort of not challenge you for the sake of it, but just to ask why you're doing it, because they know that it's not the right thing to do, and actually bring some logic and fact to the argument to help you, empower you to make a good choice. Moving on, what else has happened since January 25? Well, fund changes, fund mergers, fund suspensions, there's a lot of them. What have we seen? I'm just going to take you through the last 6 months alone. We've got a system in our business which tracks all the fund mergers, name changes and suspensions, and we can just see them very easily what's happened this 6 months. So January 25, we had Fidelity Investments. They had a fund name, objective and policy change. In February 25, we had Franklin Templeton. There was a fund management change there. We had a merger of one of their funds from Asia, merged with an emerging market fund. In March 25, a company called Arc Time, there were 4 fund suspensions, all in the property section. They're still on suspension, and we are managing that on this round of portfolios. I'll tell you more about how we're managing that in a moment. In March 25, we had 13 name changes in Fidelity in their fund groups. In April, we had 2 name changes in Neuberger. Again in April, another name change in Vontobel. In June 25, an investment policy change for Aberdeen Global Real Estate. And just the other day, July 25, a fund merger in the Saracen Global Higher Dividend Fund. So lots of things change. We track them, we're aware of them. We communicate when we need to with the relevant people. So coming on to how we're dealing with this property, well, the solutions, some of them are investment behaviour. It's the most influential subject on investment return. Consumers tend to sell low and buy high. We should be buying low and selling high. It's a very simple concept, but extremely difficult to make happen. People's emotions get in the way, their feelings get in the way. They will not buy when the markets are down because they feel they're putting their good money into bad. They couldn't be further from the truth. They wait until the markets recover and then they put their money in. Fortunately, no one sold at the bottom. When the Trump drop came, no one panicked and fell out. No one wanted to jump out the emergency exit of the aeroplane. So well done, everybody, for sort of achieving that step. Second step is if you got cash, put it in when the markets are down. When the hot news has disappeared or it's died down, that's when the market will change. When the initial shock of the news of Trump's tariffs dampened down, that's when the market changed. no one can accurately predict the market. No one can accurately predict what's going to happen when they go up and when they go down. I think most people will know when the market is more or less at the bottom, more or less at the top. You might have a think to yourself, are we at the top at the moment? Are we on the cliff edge waiting for another drop? Who knows? Having a third of the portfolio in cash on the 3 was too much, so we've reduced that, as I've said. We're going to take 6% out, allocate that to fixed interest. So property, how are we going to manage with that? So for those people who've got property and have got this archetype property within the portfolio that's gone on suspension, and suspensions, it sounds bad, it's okay, these things happen, it's normal for a property fund. We're going to take the rest of the portfolio, put it into the new portfolio, and when this property fund comes off a suspension, we'll just reallocate it back into that portfolio. When you see on your statement, the one that's on suspension will be included. You'll see it in a list, but that's how we're going to manage that. Once the suspension comes off, that will be put back into the portfolio. For those people who are in drawdown or taking income out of the portfolio, then we'll just trade around the suspended fund. And for those people who are putting money into a portfolio and making contributions, again, we'll trade around the suspended fund. So you probably won't even notice any of these things, but I do share the sort of technical details with you. So that's it for Trentham Portfolio Update for July 2025, and we look forward to sending you some communications on the matter here, and hearing from you with any questions or insights or comments that you have. Thank you.